Welcome back to part 8 in this video series. At this stage, we will now complete the final journal required involving the disposal. I have elected to create a separate video on this specifically due to the complexity surrounding the calculation. Here is the fact pattern once again. It was discussed in part 3 of the video series. In order to account for the disposal properly, I've highlighted the key paragraphs to focus on. The company intends to keep the plant and has adopted the revaluation model, accounting for the revaluation on the net replacement value basis. So the intention to keep that impacts your deferred tax rate that you use, okay? And throughout the entire video series, we've always used your standard rate to keep and not your rate to sell. On 1 July 06, plant with a book value of 140,000, tax value of 75,000 was disposed of at a profit of 50,000. Here's a quick recap of the second journal. So due to us using the net replacement value method, we had to clear our accumulated depreciation account. So we had to basically take whatever balance was sitting in there and simply transfer it to the cost account. The impact on our carrying amount is null because we're simply transferring from accumulated depreciation to cost. The next part in accounting for the disposal is to de-recognize your carrying amount. But in order to de-recognize your carrying amount, you need to de-recognize your cost and de-recognize your accumulated depreciation of the sale. This table alone does not provide you with that information. The question mentioned the carrying amount, it mentioned the tax value of the asset disposed of. It also provided you with the profit on the date of sale. And the problem is that it did not provide you with the cost and it did not provide you with accumulated depreciation. And that's another reason as to why it makes this question hot and spicy. So in order to get the cost and accumulated depreciation, I'm going to take you through two approaches. One is the long approach and the other one is the short approach. The long approach involves working backwards to get the cost and accumulated depreciation at different intervals on the timeline. So let's assume that the cost of the asset that we disposed of was X. So at acquisition, the cost is X, our accumulated depreciation is null, and our carrying amount is X. Thereafter, as at 1 Jan 06, before the revaluation took place, our cost was also X. Our accumulated depreciation of Y represents accumulated depreciation for 24 months. Our carrying amount at that date is now X minus Y. Before the revaluation happened, the NRV adjustment took place, which simply meant that whatever was sitting in our accumulated depreciation account, being Y, that was simply transferred into our cost. So our carrying amount due to the NRV adjustment, the impact of our carrying amount is null. After the NRV adjustment, our cost will be X minus Y. Our accumulated depreciation will be cleared. It will now be null. And our carrying amount after the NRV adjustment will be X minus Y. Now that we've gone through the variables involved in this complex calculation, let us assign a sequence for how we will get the different values. We will start with what we've been given. We've been given a carrying amount of 140. We will then work backwards to get the carrying amount after the NRV adjustment. This will be the same thing as the carrying amount before the NRV adjustment. We will then work a step back to get the carrying amount at the date of acquisition. Then we will get the cost. We will then get the cost before the NRV adjustment, and then depreciate. Then we will perform the NRV adjustment, and then we will end up with our cost and our accumulated depreciation after the NRV adjustment. Our final step would be to get the cost of the asset disposed of at the date of sale, and then we will get the accumulated depreciation of the asset at the date of sale. Before we move into this calculation, it's very important that you understand what the remaining useful life is at different points of the timeline. So first and foremost, 140 is step number 1, what we've been given. Step number 2 is our carrying amount after the NRV adjustment, which is equal to 140 multiplied by our remaining useful life of 30 months on the date of the NRV adjustment, divided by 30 being the remaining useful life on the date of sale. So point number 2, we get a value of 168, which is the exact same thing as point number 3. In order to get the cost at the date of acquisition, we will take 168 being our carrying amount as at the NRV adjustment, multiplied by our total useful life of 60 months divided by 36 months at the NRV date to give us 280. Our cost at acquisition now is the same as our carrying amount being 280. The next step is basically to roll forward the 280 from our at acquisition date to before the NRV adjustment. We will then need to account for depreciation of 2 years or 24 months being the cost of 280 multiplied by 24 months over your total useful life of 60 months to give you a value of 112. We will then need to clear our accumulated depreciation account, and our cost after our NRV adjustment will thus be 168, and our accumulated depreciation account will now sit at a value of 0. The final step is to calculate the cost at the date of sale, which is 168. It's roll forwarded from step number 10. And our accumulated depreciation at the date of sale is 168 multiplied by 6 months divided by your remaining useful life of 36 at your NRV adjustment date to give you a value of 28. Thus, using our long approach, we now have the hidden variables of our cost and our accumulated depreciation. You may want to pause the video and go through the steps once more on your own. With the shortcut approach, you can simply get the cost and accumulated depreciation using the parts approach or using ratio and proportions. In order to do this correctly, you need to correctly identify how many parts represent the cost? How many parts represent the accumulated depreciation? It's very important that you assign 36 parts to the cost and not 60 parts. If you assign 60 parts to the cost, that is where you will get the answer wrong. And that's specifically why I showed you the long approach, in order to illustrate the complexity that the revaluation brings into the whole mix. So please bear that in mind. If you're using the shortcut approach, you must assign the correct amount of parts. Your accumulated depreciation will be 6 parts because you do hold the asset for 6 months in your current financial year before you dispose of it, and your cost price will be 36 parts and not 60 parts. Using ratio and proportions, you simply take your carrying amount of 140 multiplied by 36 over 30 and 140 times 6 over 30 to get the cost and accumulated depreciation respectively. Your value of your cost is now 168 and your accumulated depreciation is 28. You now need to journalize this now that you have the values. Your journal will simply be debit accumulated depreciation of 28,000, since you are derecognizing your accumulated depreciation. Since you are derecognizing a cost, you credit your cost by 168. Your profit or loss on disposal of 140 is what's given to you. In terms of the question does give you your profit of 50,000, but it doesn't account for the proceeds, even though you can calculate it using the profit figure provided. I hope that you've enjoyed this video. Please like and subscribe for more.